Hi there and welcome to MPC Markets Structured Products Thematic Investments webinar. This webinar is for wholesale sophisticated investors only. The recommendations in this are general advice in nature and don't take into account your specific circumstances. Now, I'd just like to start by introducing MPC Markets. We were founded about 2.5, 3 years ago. Myself and Kai Chen were the founders, and we, come from a background of professional trading and derivatives. In both, high frequency, algorithmic, and I even started back on the trading floor back in the mid-90s. So essentially, we've gone about pulling together packaged investments with multiple structured products to represent thematic views and lower the risk, but increase the capital efficiency, but still get all the upside. So it's been an interesting exercise in terms of pulling together multiple all at once. And I've got a few examples for you today. But look, the team here has got 60 plus years of options, derivatives, investing experience, trading experience. And we generally, particularly when using StroPro, we're generally working with them to, construct sort of bespoke strategies that represent themes or views, not just one-offs in the fixed coupons or the smart entry notes or the enhanced growth, etc. We try to pull together and give the ability to be able to mix and match, construct, smooth out the risk, and use some capital efficiency. So the reason I wanted to sort of give you the background on the team was, Kai, for instance, it brings an actuarial, high frequency trading, algorithmic trading background. Was a prop trader at a firm that I owned many years ago as well. And particularly in the equities, derivatives markets, he's got real world experience in live real time in assessing risk, opportunities and timing. And that really, Kai really brings the cornerstone of MPC Markets being able to pull together these and price up these bespoke strategies. Head of trading, Jonathan Takadina as well, 25 years experience in thematic investing, equity options. He's got a really good practical background in applying capital efficient investing techniques, and a lot of experience seeing thematic investing cycles, particularly in the mining sector, but many other sectors as well, from obviously origin through to almost bubble stage and then beyond that. So, there's a lot of experience there in pulling these things together, and it's where we get that unique view and this unique approach overall. So I'm going to run you through a few of the previous investments we've done over the last 3 months, and then I'm going to run you through some capital efficiency tactics as well. So where we're combining the strategies to lower the risk and maintain the returns. So the 3 high conviction thematic investments we did, AI, robotics and automation was one of them. Hyperscaling AI, which was the rapid expansion of data centers, and store of value, which is gold and silver investment, which we've done. We did a 12-month investment in 2024, and we've done it this year as well. So we'll just run you through, and there's different ways. So I'm going to run you through the store of value first, but our September 2024 store of value, which was just straight gold and silver, using the enhanced growth strategy, was a 10K investment for 100K notional exposure. There was a 313.25% return on equity, return on investment, over that 12 months. We actually ended up rolling that early this year in August. And I think the current one we did gold miners and then silver, just because we just tweaked the strategy slightly. And that one currently stands up, is paid off the leverage and I think is up around about 20 or 30% at certain stages. So June, we did geopolitical investment, which was silver and platinum, but we also had some defense stocks in there. The silver and platinum part, it was a bit more expensive, but there is a lot more upside. But it was, 18K for 100K notional exposure was up 138% in 5 months. This was as at sort of September. And then even in August, we did the hyperscaling AI. Two of the strategies within that entire investment at stages were up 83 or 15%, 83%. Obviously, it moves around a bit because there's, we're talking notional. Once you've paid off the leverage, they whip around quite a bit. But essentially, at stages, all 3 of the of the different investments, enhanced growth investments within that package. Let's start with the simple one, which is the Store of Value Plus. We did this year in 2025 in August, we did silver and gold miners investment with enhanced growth. Previously, we just did silver and gold, straight commodities. So every single time we do one of these, there is an investment document with the investment thesis explaining why we like it, giving all the investment catalysts, why we've chosen what we've chosen, usually about 6 to 8 pages long, and then it'll have the investment at the end. So these are just bits and pieces from, from these documents here, because I'm just obviously trying to run you through 3 of these. But one of here are the reasons, essentially: spiraling US debt, lower US interest rates, US dollar weakness, central banks buying gold, BRICS de-dollarization. And then you've got the chart on the US debt spiral currently, is obviously making people go back to gold, go back to silver as well. Geopolitical stress was another one that particularly involved silver and platinum, just because, Mexico is one of the bigger producers of silver. Russia's and South Africa the major producers of platinum, and that really played into that geopolitical stress as well. So, and then here were the reasonings why we're pairing up gold and silver, because silver is actually historically extraordinarily cheap versus gold. We don't normally have much time, in the last 50 years, anywhere near that 90 to 1 ratio. I think it's currently around the 80 to 1 ratio, but the 50-year average is 60 to 1. It's 60 ounces of silver to 1 ounce of gold. And this is a little bit old. It was way back when we did the, initial investment. Silver's since rallied, as has gold. So that price is more like $63 to $65 now for silver. If the ratio was to return to the 50-year average. And the reason this time, instead of just the gold price, we went with gold miners via the GDX Gold Miners ETF, was the gold miner profit margins are at record highs. So for every percent that gold goes up, obviously the EPS extrapolates out at a far higher pace for the gold miners at these levels than it will in the actual gold price. So, and then with this one, the 2024 version was 10 to 1, $10,000 for 100 notional. This one was 13,000 for 100 notional, a little bit more expensive, only 12 months. And look, I mean, essentially, for your $13,000, if we end up being up 40% at the end of the 12 months, you're getting $40,000 back. For up 10%, you're only getting 10% back, and if it's below where we entered, it's zero. Obviously, you're marked by worst in basket, as with most of these structured investment products. But as I said, last year for the 10,000 down, I think our clients got back around about $41,000 or thereabouts. But we would be invested in these high conviction trades anyway. We would be invested in gold. We would have been invested in silver. But we got the opportunity to essentially represent exactly the same view, but only put down 1/10 of the cash, or in this case, $13,000 out of 100,000. So it is very capital efficient to represent the same view. I don't necessarily see it as leverage in terms of I would, what I generally recommend to our clients is tell me what you would like to invest notionally, and then we'll apply the cash investment backwards to that. Rather than I'm not turning around to clients and going, chuck in 100,000. If it goes well, you're going to get 9 times exposure. That's not really how we play it. We'd much rather be sensible with these things and just manage them in a much more risk efficient manner. Here was another one that was extremely popular. I think this was the biggest investment we've had at MPC Markets by quite a length, actually. We managed to get in just before that Oracle result, and things took off. We had 3 different pairs, but it was all about the rapid expansion of data centers, almost a picks and shovels play on what was going to be expended over the coming years. We didn't really want to get into large language models or software, etc. We don't think that's coming for at least a year or 2 minimum. But we just knew that they needed to build the infrastructure, and that was going to have a lot of create a lot of demand, not only in chips, but just in basic resources. Commodity demands alone We put in the copper miners ETF, and we put in a water and water management and cooling company called Ecolab in one. So that was the commodity demands. Secondly, we knew that it was going to demand a hell of a lot of power and a lot of power management systems. So we put in Oklo, which is a small modular reactor company that's been extraordinarily popular since we put on this investment. This stock's been anywhere from up 160% to I think it's up about 85% here at the moment. Vertiv itself was up 45%. This particular part of this particular pair at one stage was up about 180% return on investment. We only did this about 2.5-3 months ago, so it was incredibly good timing. Realistically, we'd been doing a lot of research into this for quite some time. Copper took off as well. Ecolab's been dragging this one back, and you've got to be mindful of the worst of. But overall, we've still got roughly about 21 or 20 months to go on this strategy because it was a 2-year strategy. So essentially, if you invested in all of them to get 300, so they're 3 different pairs. If you invested in all of them to get $300,000 exposure, you would have invested, somewhere around the $45,000 mark or thereabouts. And essentially, you're getting that, you're getting coverage on all of these thematics. But if it doesn't play out as fast as you think, or as fast as we think, or the market goes backwards, or there is a repeat of 2001 tech bubble, all you're risking is that 45, or roughly, I think it was on average, it was about $15,000 per $100,000, notional exposure. You're only really risking that 15%. So that's a really good thing, particularly we were investing these in what we thought were potentially fairly dicey times ahead. It was coming into September, October, which is seasonally weak periods. And we were concerned that, the market was at record highs. So one of the things, everyone thinks about the leverage and how much extra exposure they get. But what they don't think about is that whatever you put in is capped, that that's the most you can lose. So you've got a 2-year period now where for this one, for instance, you're 12,000 down for your 100K exposure. If we were to have a market meltdown for a few months, some of these stocks could halve. But your maximum loss at any given time is only that $12,000, and then it's got all that time to recover. So you're not panicking, you're not worried. You get to set and forget, let it play out. You're getting your maximum amount of exposure to the upside that you were going to put money in anyway, and you're doing it, as I say, you're doing it with $45,000 instead of having to put in $300,000 in capital. So we were so concerned at the time that we actually put a market insurance or a hedging tactic in this, because at the time, and this is very relevant now. This is kind of even worse at the moment, and it's currently the 5th of November. We've just had the Nasdaq down 3% in the last sort of 36 hours, but every signal we can see, the Buffett indicator, Schiller Cape ratio, trailing PEs, dividend yields, the Hindenburg omens come up as well in the last week. Everything was showing overvalued, but volatility was very low. So it meant that for every $3,000 we put down, we got a hedge of $100,000 notional. So then we went, and it was just for 3 months. This thing will expire at the end of November. At the moment, we're currently sort of 6 or 7%. Well, we were probably about 6 or 7% behind on this. We're currently now probably only about 3% behind on this, but you're getting 33-to-1 coverage, on the leverage to the downside. And the reason we went with the short-term hedge is if you go back and do the stats, basically since the GFC, returning to break even has essentially only taken 127 days. Prior to 2015 or 2011 period, it used to take roughly about 4 times that to get back to break even. So the market moves much faster these days. And as you can see here, China slowed down deflation fears, and then Liberation Day. We're talking 2, not even 3 months in some occasions. So that's why we went with the short-term hedge, and essentially using the low volatility to our advantage by getting a very cheap, I guess, market insurance policy. So most of these strategies, if we go back, had the market been a lot lower, would probably have been more expensive. So really, we weren't actually spending that much extra money, but we at the moment, if the market does have a short, sharp fall, we've got government shutdowns currently going on in the US. We've got Morgan Stanley and Goldman Sachs CEOs basically saying the market could have a 15% pullback overnight. I mean, this is the kind of thing that lets you at least sleep at night. And for instance, if it was to be down 10% by the time this thing expires at the end of November, then essentially the rest of the strategy then becomes a free hit. So it's just, but again, it's where these are three different pairs representing three different parts of the thematic. So you're only marked to the worst in each basket, and then on top of that, you've got this hedge. So realistically, it's four different strategies all packaged up into one investment. So that's where obviously we come in, because we've obviously got that expertise, and we're making sure that we're hedging to the downside and also taking advantage of that lower volatility, but getting capturing all the upside essentially at the end of the day. So if you really think about it, you're putting down less capital and you're getting the same result, and you're basically setting a max loss. So everyone says, they use stop losses until their stop loss gets hit. So this is a great way to do it, whereby, you're capping your downside, which for most investors is quite often their highest priority. So the last one we did, and we did this about 3 or 4 weeks ago, is the AI, robotics and automation. We have broad sectors like fully self-driving transport, logistics, manufacturing, collaborative robots, and humanoid robots. They were the three investments. Again, as you can see, total addressable markets were all done, projected valuations, use case examples, compounded annual growth rates of the sectors, etc. What the technology is doing. You're going to get those investment documents every time with us that explain the whole thematic from start to finish. And then if you like the theme and you want to invest, obviously then you can mix and match you can do more of one than the other. You can miss one out, you can miss two out, and just do one of them. With this one in particular, TSMC and Tesla was the broad AI, robotics and automation. Some people just did that one. And then everyone else mix and matched how much they wanted to allocate to the rest. But, all of this research, again, this is the AI robots market, the fully self-driving total addressable market, which will be enormous and in the trillions. So it's all heavily research-backed. And then we got here, this was the reason we went broad, because TSMC is going to benefit as a foundry chip maker and a high-grade chip maker. But Tesla as well really fit into nearly all three categories, to be honest. Fully self-driving cars, humanoid robots, they've got their own AI. It's an all-rounder. And hence why they went, a lot of people just went for this one. We did look at other players, and we did list other players as we went through it. But, as you'll see later, we used a few of those for what we combined a fixed coupon note, which yet again is just another way of uniquely using these products in combination with each other to represent a capital efficient view. So warehouse and logistics, it was Zebra and Teradyne. Honeywell and Symbiotic were ones that were sort of, we didn't like either the price that they were at, etc. We usually have a list of things there. Cobots and humanoid robots, Symbiotic and Intuitive Surgical. I mean, Intuitive Surgical's already shot the lights out since its earnings about 3 weeks ago, up about 30-odd%. Symbiotic also doing very well. I think that one actually has covered the leverage already, give or take a couple of days. Probably not, given the market's off pretty heavily in the last 36 hours. So same again. It's about 7 times leverage, 14 grand cash for 100 grand exposure. Zebra and Teradyne a little bit more expensive, much higher volatility, and then Symbiotic and Intuitive was 14. So yet again, we're still around that $15,000 per 100,000 mark, say. So what we did here is, so we would want to invest in all of these stocks. If we're stockbrokers by our backgrounds, in terms of the business here at MPC, if we would need to go and spend 100,000 per pair on all of these in cash to get this sort of exposure. So that's sort of $300,000. So instead of tying up 300 grand and buying shares, instead we spent 48,600 and we got the same dollar amount exposure to the same stocks. Now, I mean, obviously they are pairs, you mark to the worst, etc. But, you've also got the benefit of having cap downside and things like that. There's a little bit of give and take. But my main point here is that this leaves you with 251,400 in remaining capital to invest. Now, we do a lot of fixed coupons here at MPC Markets. We formulate our own. We strike at timely periods, etc. But basically, if you went put 48,600 into all of these, you're getting 300,000 exposure. If you buy stocks, 300 grand for 300 grand. 250 grand capital left over. If you put them into fixed coupons at 13.5, and I think we got 13.8 in the robotics fixed coupon note. If the market was to crap out or get really badly hit, down 35%, you're about 130 grand better off, because you're getting all of your coupons still, basically out of the fixed coupon note. Obviously, you've given up your capital in the thematic, but much better than if you would have just bought stocks only. You'd be down 111 grand. If it was flat, you'd still pay 6 grand in brokerage there. You'd still be 25 grand better off with the fixed coupons and enhanced growth combination. If the market's up 50%, you're going to be up 144,000 there. But again, you're going to be 25 grand better off overall. And so, as I say, if the market gets hit, you're still making money. If the market goes goes madly to the upside, you're still making more money. So essentially, same view, better way to do it, and a lot less sleepless nights. So yet again, we could have done a fixed coupon with the hyperscaling. We chose to do a hedge, but as I say, combining the strategies together to represent a view or a thematic view is, where we have that unique edge in the structured investment space. And I'm sure, the guys at StroPro particularly are, probably get mildly frustrated with us at times because we're asking for prices all the time. But their markets guys are the same as us, and they're quite enjoying watching these strategies go well. So we've got a platform here called MPC Mosaic. Was launched in the last month. It's got all our webinars, podcast news, but what the most important thing is, we're very happy to give a free trial to anyone, 1 month free trial with all of our recommendations. But the structured investment deals get pushed to the app whenever they come out, and you'll get all of the research, all of the webinars, the recommendation, etc., and all the investment documents. There's a broker chat. You can chat with us anytime, and then it's got all of our research and things as well in there. It's available on desktop, phone, or tablet. Available on the App Store, Google Play, Android Store. But you can go and sort of have a look there. But every time we have an investment come up, you don't necessarily have to be checking the StroPro website. You'll get that investment from us. And look, some people just might want to buy one stock or etc. There's really good stock picks within there, because we've gone and vetted probably 20 or 30 different combinations or different stocks, etc. There's months of research and work that goes into these, and then we wait and we time them fairly well. So it is important to to be available to be able to go, yes, I'm interested. So MPC Mosaic, you can go and have a look at that. So I hope that answers a few questions, and I hope it gives you a bit of a unique way insight into how you can be using structured products, not just in single product variations, and how you can build a bit of a portfolio and do all of the things you can do in stocks, just in a much more capital efficient and less risky manner. So if anyone wants to contact us, invest at mpcmarkets.com.au. My email is mark.gardner@mpcmarkets.com.au. Our phone number's there. Or you can contact us through the guys at StroPro, Louis, Anto. they'll get us in touch. But thanks for listening, and hope you got something out of it, and hope you look out for our next strategy. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.